welcome back. Welcome back. Let's get into it. I got to tell you, I'm looking forward to a long weekend. What up, chat? Let's go. I've been doing a lot of work on the back end, trying to get things put together for some charts that we're preparing to show to you guys. Some of which I've already teased. The synthetic volatility index, for example, great example of that. It's our substitution for the VIX model. But there's a lot more, and we're going to get into some of that today. Certainly, we're going to talk about liquidity at the Fed. We're going to talk a little bit about some of the revelations I've had around home prices. I may have been wrong on something, so it's incumbent upon me to be honest with you guys and tell you where I think things could have and should have been different, at least from a narrative perspective. The chat, yo, what up, Regil? Friday in the Fed, let's get after it. We're going to spend a little bit of time getting into vacation light. Looking crispy, hard work does not go unnoticed, sir. Thanks, Samson. I appreciate that sincerely. I got to tell you, it's been wild. Working hard on the back end. Yes, Joe, very, very hard. As a matter of fact, let's get right into that, and then we'll cover some of the intro stuff later on. I've got a new chart to show you guys, and here it is right there. Boom. Liquidity Pulse Index. This is pulling directly from the St. Louis Fed. We tapped into the API. We're pulling that data in, and these are the line items that you're getting. You get the Fed balance sheet, you get the reverse repo line, you get the Treasury account, and then you get a net liquidity level, which basically takes the previous Fed balance sheet and subtracts the other to give you where net liquidity is in the system to come up with a liquidity pulse score. This score tells us how much drainage of liquidity in the system or how much we're flooding it with liquidity in the system without having to know all the nuances of how the Fed line works. So this was our answer to that. It looks very aesthetically similar to some of the other charts you guys may or may not have seen from us in the past. But this right here is going to tell us a whole lot about how much liquidity is in the system. And the narrative down below, we're currently in a, quote, tense set of circumstances, right? So if you look here, that is your composite score. It's derived from this figure down here, which really subtracts these two from the previous one up here. And this goes to show some pretty interesting theories as it relates to Fed money. Number one, you can have a Fed balance sheet which looks like it's flush with cash, which we do. Okay? But you can also have things like the Fed's reverse repo line showing that money is going out to banks who are requesting it overnight, which is what we're seeing here. And you could have a Treasury account which appears to be supportive, but when you subtract those two from the previous, you get a pretty tense liquidity position. So a very different set of circumstances. What up on X? Yo, I see you, Sonny. How you doing, brother? Let's see here. Chris, how you doing today, sir? I'm doing good, man. I'm doing real good. We're hoping that a lot of this presentation-wise helps a lot of you out there. Welcome to the people on X who are seeing us for the first time. We're streaming this entire show live in 1080 on X on that platform. So your liquidity position from the Fed is what I would call tense right now as we're describing it with this chart. As you start seeing liquidity flood the market, you're going to see a very different economic environment than when you see it drain the market. All of these charts that we're going to present to you today, and I'm going to switch to the current market status chart, the U.S. market risk profile. We are currently in a tech-led narrow rally. All of these charts are designed for one simple concept. These are not, hey, how to invest in the future. These are charts on, hey, this is what the market looks like today. We're trying to give you, the listener, the viewers, a snapshot of what the market looks like at any given point in time so that you can feel pretty comfortable knowing where the market's at without having to know the technical nuances of some of these things. Some of the questions we've seen historically around why we're using, on this chart, for example, here, ETFs as opposed to the actual indices. We feel that ETFs are a more indicative response to the market. And I think the major, the criticism of this is that it includes derivatives and all sorts of other things. And yes, we want it to include those things. We want it to be a real market snapshot that shows all real market action, including options, including derivatives, including all the fun stuff that happens on a daily basis, because that's what actually impacts our dollars and these ETFs and their vis-a-vis that our money. So we wanted this to be a better proxy. Of course, the percentages that you see here do change in line with the indices, which is why this is a perfect real-time proxy, at least in our supposition. I did get a question from somebody in the chat saying, hey, are we going to get these models broken down to us? Yes, we are. We're going to provide you the models, some of the baseline analytics that go behind them, and some of the math. We're going to keep some of it proprietary because I don't want the entire way that we come up and derive these things to be out there for display in a full view, because frankly, worked hard on this stuff. But that being said, let's look today and let's go down this process and we can figure out exactly the current state of the market. And I'm going to tell you guys the big revelation I had around housing and about interest rates because I may have been wrong. Saeed insists that I wasn't, but yeah, I think that I may have been a little wrong, or at least a little callous when I shouldn't have been. And shout out to Logan over at Housing Wire. He may have been right this entire time, as much as it pains me to say that. So look, the Dow Jones Industrial Average, we're all up on all the major indices today. S&P, NASDAQ, Russell, and Composite. What this really means, again, for a refresher, is we have a slight tech-led growth rally going on here. We're not spreading beyond tech into the rest of the market. So again, the top upper echelon of tech-based companies that of the Mag 7, for example, Mag 10, if you will, are really pulling the market forward today. So it is a narrow rally. It is focused heavily on tech, and that is the current state of the market. Let's go over to the synthetic Volatility Index, another one of our fun little toys here. We're taking the realized volatility, the intraday stress, and the gap risk in the market and cross-market volatility to come up with a synthetic volatility score. In this case, that is a 90. That tells us that the market is, in fact, in a calm position, and it's not trading based on erratic behavior. It's not unstable. It's not certainly tense. And all eyes are on Davos right now. We know the president's going to come out, going to say some things about institutional investors, presumptively, about how home affordability is being impacted. And who knows, maybe he'll roll out a 50-year mortgage plan. You never know it. You have no idea what he's going to roll out. But for right now, the U.S. market is in a tech-led narrow rally and in a calm current state. So that's a really interesting perspective to have right out the gate. Even if you don't know the markets, you can tell looking on these charts. And for those of you who want to know where these numbers come from and how we come up with them, we'll put together, again, another presentation for that on the website. But effectively, we're taking the volatility in the day on the major indices. We're taking the intraday range stress as the highs and lows. We're taking the gap risk between one indice versus another, and we're trying to see how they're all trading throughout the day algorithmically compared to one another. It is worthwhile to point out before I get into the next chart, the liquidity chart here, that all of this is supposed to be a non-emotional look at the markets. One of the things you'll see on X in particular, for those of you watching there, is that there is a huge amount of emotion vested in the outcome financially for everybody, all of America, right? Like, our wallets are tied to this stuff. We want to make sure that financially we're all okay. And we all have a pretty strong emotion to this. Those people who believe investing in the stock market and who have a whole lot of stock or a 401k, they want to see the stock market stay up. Those people who own a lot of real estate, they want to see real estate values creep up and stay up. And you've seen the president, who's very concerned about values coming down for a lot of his primary constituents and some of the statements that he's made. We're trying to divorce ourselves from what we humans want and feel and look straight at the quantitative analytics, the numbers, right? And this is similar to what hedge funds do for a static look. They then take all this information and they'll figure out how to invest and make investment decisions based off of it. We will get there at some point in our distant future, but for right now, we're just trying to give everybody a snapshot of the day based on how the markets look. We covered this a couple moments ago. This is the Fed balance sheet. This is pulling straight from the St. Louis Fed, and I'm going to show you the next chart on housing, which also does the same thing. We'll have one for jobs here in the not too distant future as well. The Fed balance sheet is flooded with liquidity. Reverse repo line is, in fact, restrictive. It's really the delta between those two things that is putting us in a tense liquidity position for the market. You did have the president instruct non-Fed decisions to happen, Fannie and Freddie being told to buy, north of $200 billion of mortgage backs, which is going to have the net effect of lowering interest rates over time, somewhere between about 25 to 35 basis points. And that's meaningful. Meaningful because of the next chart. So let's get into affordability. I present you all the Home Affordability Index. Now, this has been a bit controversial. Saeed and I have gone back and forth debating the value of this and how important it is for everybody else to understand. We know that homes are at or close to their all-time affordable pricing. And frankly, when I say pricing, I don't mean just the home value. I mean all the factors that go into it. And this is a really important point to pause on and take the serious stance and look at you guys over here and say, okay, look, there are three major components to housing affordability. Number one is obviously the price of the home. I think we all understand and know that. Number two is the interest rate environment. And we hear a lot about the interest rate environment in everything, from the news, from the political rhetoric to everything we see online and on social media is all about how rates are impacting this one way or the other. There are pundits on one side of the aisle who believe that mortgage rates are 100% the reason why homes are unaffordable. And there are pundits on the aisle that I was on, which suggested that home affordability is really the result of price increase in value of the homes at a cadence that we could not sustain, frankly, from an economic perspective. And the third portion here is wages, right? Wage inflation is not keeping up with housing inflation and shelter inflation. And shelter has been the biggest drag driving inflation up economically over the last several years, which is part of the reason that the Fed is acting so hard to protect their dual mandate, right? That, of course, being to have stable jobs and stable price inflation. So we are seeing this constrained Fed, and we've talked on previous lives about how there seems to be a divergence between the inverse relationship of inflation and jobs that we haven't seen historically. And I think the efficiency from AI and some of these companies is really coming to a head and driving that. And hopefully in the next couple of quarters, we'll get some insight and some vision into that. But for right now, this home affordability chart is really important. We're going to talk about where this comes from and why, okay? Because this was enlightening for me. Number one, payment burden. Now, I wrote this down. It was pre-scripted because I knew that I wasn't going to remember it. So I'm actually going to post this. If you're on X, I'm going to post this in the not too distant future here. Yo, is this useful? Why don't you have many viewers? I don't know, man. I think a lot of reason, and this is Andreas, I think a lot of reason we don't have a lot of viewers is number one, we're a very technical show. Number two, it's educational. Most of our viewers go to the podcast. The podcast gets somewhere between 20 to 30,000 streams on the audio platforms a month. We were very late to video production, and we very rarely put this onto places like Instagram. So viewer-wise, as much as we like to deliver a high-value content, you'll find that most of our viewers are on other platforms, and particularly the streaming platform. The live stuff is really, this is kind of like an added bonus for the podcast where we speak a little bit more colloquially, you'll have a little more fun. But this is the technical side where you can follow along and get a lot of the detail and breadth we don't normally provide on things like the podcast because we feel like this is a better venue for it. And visually, I think there's a component here that really is important because I'll be able to point out stuff that you're looking at here. So let's get into the Home Affordability Index and why it's important. I think that's hard to watch during work, but I always watch the lives when I can. Thanks, man. I know it's hard to watch. That's why we obviously record them and put them out. But one of the things that I think is valuable is doing this intra-market during the day so we can kind of respond in real time to what's going on. That's also part of the reason the stock ticker's down here. But if you ever have to watch while you're not at work, just know that you're going to get the timestamp down here. You're going to get real-time stock tickers, and including the ETFs that we track down below. We're using our logos for those. And then you're going to get a good proxy for what's happening through the day. I always try to highlight on all the charts over here that the market is open or closed, or whether we're pre-trading or post-trading hours, so you have a good understanding of where our mindset was at the time. Right now, there isn't a lot of volatility in the markets, and a lot of the charts that we started off the show early with show you that there's nothing to be really concerned about. So I wouldn't expect there to be anything, kind of meaningful throughout the day. This is more of an educational thing. So let's get to the home price burden here. I'm going to show you what I started to write a little bit here. And I basically, I'm going to show you the title behind the scenes before I post it because I know Saeed's going to probably have an emotional come apart here. But effectively, the title of this is going to be, I was wrong about housing and the math changed my mind. And this is why. So let's look into the lines here that are important. Okay. And let me pull up the right math here because I want to make sure I give this to you the absolute right way. Okay, so for the home affordability, we're pulling this in from the St. Louis Fed. This is data, their most recent data, which I agree, and this is why housing is a lagging indicator, is of Q2 2025. Q3's numbers just came out, and hopefully it'll update in their API not too soon from now. Taking the median average home price of $410,800, and at the time, the median interest rate, which was 6.77%. Those rates have since improved since then. But that is as of Q2 of 2025, and that's where these numbers are really coming from, and that's why that date down is there, important. So for the mortgage payment burden, we did a very simple thing, okay? We started with the median home price, which you see there. We assumed the standard down payment of 20%. Now, that's not to minimize how difficult it is to really have 20% to put down. I'm not saying that most Americans have that. As a matter of fact, I'm going to tell you that most Americans do not have that, and that's kind of crazy because, again, wage inflation has not kept up with the cost of living and the cost of buying a home, so putting down 20% is a massively difficult thing to do. But again, this is the standard, so we're using it here. So median home price, standard down payment of 20% assumed, and we're applying the prevailing 30-year fixed mortgage rate, which in this case was a 6.77% as of Q2 2025. And that came up with a monthly principal and interest payment based on the Fed's data, okay? We then divided that payment by the monthly median household income as reported by the Fed. So again, using their numbers, that comes up with a payment to income ratio, which is then compared to historical levels and converted to a 0 to 100 score, which is the score you're seeing here, okay? Very simple, not very difficult. Basically, payment to income ratio, comparing that historically, and the comparative part there is where we get a little bit proprietary, so I'm not going to give it a whole lot there. But suffice it to say that based on that, the mortgage payment burden is in the lower third, if you will, of historical availability. So if you, said another way, we are at near all-time unaffordable prices straight from a mortgage payment burden in the current interest rate environment. Shouldn't be a surprise to anybody, but what is surprising to me is the next line, the rate pressure. I did not expect this, and it being 13 here is going to be indicative of where my perspective shift is, and I'm going to explain the math on it to tell you why I think mortgage rates do need to come down. And I would not have said that to you a week ago. Just because I've always been home prices should be the major mover, and I don't think that's real, and I don't think that's mathematically accurate, and that's where my own emotions got in the way. Okay, so the mortgage rate pressure is using the current year 30-year fixed mortgage rate again. In this case, 6.77%. We're going to compare it to long-term historical mortgage rate data. In this case, we're looking at data as far back as the Fed data goes, which I think is like 50 plus years. And then we're going to also normalize that into a percentile-based 0 to 100 score. So basically, if you look at the mortgage pressure, our mortgage rates relative to historical pressures, and I've always thought that 7 to 8% was the average rate, and that is, but looking at the mortgage rate pressure over the last several decades, something I missed was the last 14 years of artificial interest rate deflation where we kept rates artificially low. So low that you were at like 2 to 3%. On average, I want to say in and around that period of time, people have mortgage rates. And if you look at the mortgage disparity, there's a lot of people in America. So 40% of America owns their homes in cash. Okay. 60% of Americans who do have mortgages, 60% of those have mortgages below 5%. So and we'll look at some charts later on that'll explain some of that. We did that on a previous live if you want to go down that path. But certainly, if you think about it in the context of that, lower mortgage rates right now, even where we fell last week, where we saw a 40% pickup in refinances, didn't move the needle a whole lot for most Americans. Why would you refinance if your mortgage rate's below that? Probably because you need cash out, right? Other than that, this is not purchase applications. This is just mortgage refinance data that came out last week. So who knows whether purchases really picked up yet. We'll get some of that data on a lagging sense. So definitely a very narrow window of people that'll be helped here. But that period of time with interest rates that low brought down the average. And when you apply the mathematical look back on mortgage rate pressure, 13 low means that effectively the market is locked out from an interest rate perspective still. Now, that shouldn't be a surprise to anybody based on what I just told you, you already knew. But when you think about this chart here, the mortgage payment burden isn't the greatest impact. The price to income being strained isn't the greatest impact, although it's not good. I mean, strained is still bad, right? If you look at the spectrum here of stretched and strained are not the same thing. You want Americans to feel like they can be somewhere in this space here, ideally balanced to accessible, right? But what we're getting is a market where the supply has come back online. 89 supply is accessible in the market. You're starting to see that supply drive back up. And if it's accessible, that means you have to have something to be a catalyst to drive people to buy. And my historical perspective on this has always been that needs to be home values coming down. But home values coming down isn't meaningful enough. And this is where the math got me. And again, not to say that I'm not saying that home values don't need to come down. I do believe they do. I just don't know that alone would solve the problem. So let's go through a classic example here, and this is what I put up on the chart, and I'm going to show you my perspective here with the screen. Let's go to that. Here you go. All right, so this is the article that I am writing for X, and this is kind of the language that I put here. I think it's worthwhile to share, so I'm going to do it here before I post it live, and you'll find this article on X at some point later today and on LinkedIn if you're following there. Here's a simple logic that matters for the typical mortgage, a 1% increase in mortgage rates raises the monthly mortgage payment roughly 10 to 12%. Okay. That's a pretty healthy increase for just 1%. A 10% decline in home prices only lowers the payment about 10%. So 1% of interest rates one way or the other has the same impact as 10% going up or down. That asymmetry is everything. For the example, and I provided an illustrative example here using the 410,000, which is a little bit less than the current median home price. $410,000 home, 20% down, $328,000 loan at a 3% rate. Okay, you're looking at monthly P&I of $1,380. Okay. If you're looking at a 5% rate, $1,760. At a 6.8% rate, $2,140. That's a about 55% increase in the monthly payment without price changing at all. Okay? That's how meaningful rates are, is it's just a huge weight on the overall payment. To offset that purely through prices, home values would need to fall about 30 to 40%. So again, not saying that I disagree with our historical stance that home values need to come down. They do. What I'm saying with this, just looking at this purely from a mathematical perspective, is that you need rates to come down, probably about 1%, maybe half that mathematically, and home values to come down, and wages to go up in order to get to what I would like to think of as an accessible real estate market. A balanced market would take a combination of all three of those as well. One of those moving isn't going to move it now, but the most impactful movement you can make to improve this situation will in fact be rates. Now, I'm not saying that's the right thing to do. I'm not saying that's the right economic situation. Certainly all three of them needing to move, but in order, the most impactful movement here, and again, you can see it very clearly here, the mortgage rate pressure is the reason why that is going to be the most impactful move to drive this market from currently strained all the way to balanced and accessible again. And that's what we're trying to do here with a lot of the chart work that we're providing you is supposed to provide. It's supposed to give you guys a look that you can make that level of logical leap without me giving you my bias. Because I know we're all human, we all have biases, all right? And I've clearly disclosed mine here. That's part of the problem. Let's go to the chat. What up, Saeed? You out there? You watching? You here with us? Such a sexy chart. I do think it is a sexy chart. And I like to point out that there are more charts that are going to come out here. Wait, hold on a second. What is going on here? Oh, it's not displaying on the overlay. That's so sad. I'll have to fix whatever's going on here in the back end later on. But I am getting the comments in the feed here. I wonder if the restream stuff works. It probably does. Let's see if restream's a fail safe that I built in here. There you go. So restream does come in, even though the stuff on the chart here won't pop up. I think that's probably just more of a small error on my side of things. When I loaded OBS today before the show started, I had some technical glitches, so I think that's just something I got to work through. I last minute was trying to pump into this live that affordability chart. I had the liquidity chart prepared with the Fed numbers, but the affordability was one that I actually prepared this morning. So in doing so, I didn't reset everything before I started. I probably should have done that. It probably would have given us a little bit better performance. Let's go over to Instagram. Chris, with the 10-year Treasury doing its own thing regardless of the Fed, yes, that is happening. Are we looking at a permanent decoupling of mortgage rates from Fed funds rate, or is the bond market just calling the... okay, so there's a bit of confusion here. And I want to be clear on exactly what that is. Let me see if I can push this way. It might work, because I do think this is mortgage rates. Nope. Please enter. Oh, are they decoupling? Let's see if that'll display. No, not displaying. Okay. So the long story short here is that's actually a bit of a logical faux pas. Historically speaking, there has not and should not have been a mental connection between the 10-year and the Fed funds. The Fed funds is the cost of banks to borrow. And as a result of that, you saw banks change their rates. And people naturally thought that that was indicative of where mortgage rates were going to go. The 10-year Treasury should not be moving necessarily solely because of that. I do think they are going to continue to be decoupled. And we talked about this on a previous show where I think that the the nexus between the 10-year and the 10-year and the mortgage rates are going to continue to push mortgage rates higher. And they're not going to be responsive to further Fed fund rate cuts. Further Fed fund rate cuts are going to be all sorts of fanfare. Now, where this gets really interesting is the 10-year does respond to things like volatility. So if I were to go to this chart again and say that this were to get wonky, right, or the VIX were to jump somewhere between, call it, 25 to 40, that does impact 10-year. And you got to remember what the 10-year is. The 10-year Treasury is a confidence mark in the long end of the curve, right? When people feel more confident long term, that curve steepens. So think of it in this context, right? That's your 10-year and your 2-year is down here, right? And as people get more and more confident in long term, you can expect to get more return here. As they get less and less confident, you get less and less buyers. And what happens is the curve starts to flatten out a little bit. And over time, this part creeps up. If this part and people are more confident near term than they are in long term, that's a yield curve inversion. And a yield curve inversion is what we just got out of. And typically speaking, historically, if you look at the precedence that's been set there, when you've gotten out of a yield curve inversion like we have, you typically got a recession that follows not too long after that. So we've just come out of a yield curve inversion. We don't seem to have 2 successive quarters of negative GDP growth, which is the technical definition of a recessionary economy. But certainly that would not be unprecedented. Now, we do have some theories as to why that might be the case. And, well, you can't go through 14, 15 years of artificial interest rate deflation and keep rates artificially low, provide stimulus checks to everybody, and then try to change the narrative. Now, the previous executive team tried to do that. They tried to say that, no, 2 successive quarters of negative GDP growth is not, in fact, a recession. It has to have 2 negative quarters of GDI growth, gross domestic income growth, being down. That has never been the case historically, and there's all sorts of people who like to argue about that, but that is not the case. We've not seen 2 successive quarters of negative GDP growth, and typically speaking, for those of you who are unfamiliar, and I'm going to do this here. There you go. All right. So traditionally, recessions, like prosperous economies, last 7 to 10 years from peak to peak, trough to trough, right? So from there to there, there to there, if you will, is about 7 to 10 years. If you have artificial interest rate deflation for, in this case, 15 plus years, you can expect that this will be drawn out, right? It's just simple economic inertia. And if that's the case, then we should expect to see things take a lot longer to correct, a lot longer to remediate. So I'm not saying that we're going to enter into a recessionary economy. I think we've got some very unique economic dynamics at play. But certainly I think that the reverberating impacts of this artificial interest rate deflation, the stimulus checks, have yet to be seen and felt in the economy. And then you take stuff like AI, you layer that in, and you go, wait a minute, that's crazy. How can all these things intertwine to change the dynamic historically? Well, look at jobs. Look at inflation. You've got jobs, unemployment that was rising, and companies with earning all-time highs. You got companies, the stock market, the S&P near all-time highs, just hit them not too long ago. You've got things that are very conflicting signals, and I think that's part of what we're seeing here. But to answer the question that started all this, yeah, you're going to see a detachment of the 10-year and mortgage rates, and you're going to see a detachment of Fed funds in the 10-year as the confidence comes back into the markets is my best guess. All eyes will be on Davos. You will hear a lot about that in the next couple of days. Let's go to the socials. You know how much I love doing social work. All right, here's our socials. Kobisi letter, U.S. corporate bond downgrades are surging at an alarming pace. 55 billion of corporate bonds were downgraded from investment grade to junk status in 2025, the highest since 2020. I have long worried on the show that the bond market is going to take a real meaningful hit here, going all the way back to when Jane Fraser, the CEO of Citi, pulled out of the muni bond market. I thought the bond market was going to get flooded because they started to sell that entire portfolio. I still think that is likely to be a very big impact on the economy over time. And here you have fallen angels, rising stars. JP Morgan's comparison of more bonds cut to junk than made high grade. And the bond market is one of those things that escapes many people. I myself don't fully understand it. I've got a mentor who's helped me over the last couple decades, helped me really get a better understanding of it and speak from a more articulated place. But suffice it to say, I think this is where there's a lot of risk in the economy right now. Whether that rises to economic impacts that are meaningful to you and me, that remains to be seen. Trump administration is going to allow people to take money out of their 401ks and use that for down payments per Bloomberg. So that's actually a narrative I've been hearing a lot. That's from Unusual Whales there. Let's talk this through. Okay, let's have this discussion. We are in a position where the political party in power, the Republicans, vis-a-vis their voice in the White House, and I'm trying to be agnostic politically here, are going to think about the midterms and getting reelected. So you go down the list of things you want to try to respond to that you know are popular contention points in the mainstream and in social media. Number one, home affordability is a big part of that. So you throw out 50-year mortgages. The resounding feedback to that was negative. You throw out institutional buyers, and it seems to be kind of agnostic from a consumer perspective. Who knows what I'll say there. This has been an interesting one, but I have a little bit of objection with this. So, okay, let's say you go to Davos as the president and you announce that you can take money out of your 401k and use that as a down payment on your home. Well, traditionally speaking, and I'll try to find the chart, you've seen better performance in the stock market than you have seen in housing in the last 20 years. So if that's the case, then you're allowing people to go from one investment to another investment, which may or may not be beneficial. And you say, okay, well, they're going to build equity over time. They're putting the money that would otherwise be rent that's gone towards that. So, okay, maybe that works, and maybe that spurs something. Maybe that's a solution. But all of these things are really aimed at how do we get the popular vote? How do we appease the American public and do these things? And you're going to see the president latch on to at least one or two of these concepts at Davos in whatever announcement that he makes. And I think that's probably something we should all anticipate. This is probably one of the better ones that I've heard, but again, it doesn't necessarily solve the problem. First-time home buyers are priced out of the market. Most first-time home buyers haven't been working long enough to have a meaningful 401k, so it'll help a segment of the market. I don't know that it will help the entire market. BlackRock is eating the world. Total assets under management hit a record of $14 trillion after the firm pulled $342 billion of clients' money in Q4 alone. BlackRock is a behemoth, brother. I don't disagree with that. The Fed will inject $55.3 billion over the next 3 weeks, starting next Tuesday. They're officially launching one of the biggest QE programs in history. Giga bullish for markets. So, what does that mean, kids? Well, that means on this chart here, you're going to see a pivot from tense into what, at least if you go with the narrative this is saying, into a flooded liquidity market. So think of this side as QE and think of this side as QT. Okay? They're talking about quantitative easing. They're talking about dumping money into the market. They're talking about quantitative tightening. They're talking about draining money out of the market. And because of that, that's what they're suggesting is going to happen. If they do that, liquidity floods into the markets. Liquidity then gives everybody buying power, it stimulates growth in the economy, and that's effectively why someone would be, quote, giga bullish. You gotta love all the language you get on social media. It's great. So let's take a look at percentage of inflation dropping like a stone. Powell's Fed is late again, another mistake. Yeah, I don't know, man. Some of the stuff that I see from people on social media is kind of wild when it comes to the stock spread. Yeah. And let me show you a chart. Let me show you exactly what I mean, why things are bizarre. It's a great chart, right? Bitcoin Teddy. Imagine spending 14 hours a day projecting cash flows and learning business fundamentals when you could have just bought a piece of rock instead. And what he's basically referencing is the S&P 500 versus gold. Gold is outperformed. And the irony here is if you look at this chart, and let's see here, I'll go to the screen view, pull this bad boy up here. And if you look at this chart, the irony is if you were to plot housing, it would be right there. That's where housing would be. So, and housing's gone up like 50%. That's how much these have grown. That's how much that has grown. So we're in a very, very strange time economically where things don't seem to align with traditional narratives, and things are going to get a little weird. Everybody's always worried about global debt. I'm not as big of a concern, but certainly some of the tariffs on China may come through. And here's one of the interesting narratives that I've seen so far. This is something we're going to talk about a little bit about, and then I promise we're going to end this a little bit shorter today because I think that we're going into a holiday weekend. I don't want to be super technical going into it, and there hasn't been a whole lot of news that I think is really worthwhile disrupting anybody's week. So 125 years of market history tells a simple story. Stock and earnings move together with a 98% correlation. Historically correct, now incorrect. And I'm going to explain this. The short run is all about noise. The long run is all about profits. Speculators chase noise. Investors follow profits. Historically, that's been correct. Let's dive into this chart a little bit here. I'll put you on the screen so you can take a look. There you go. S&P 500 index typically follows S&P 500 earnings. Traditionally, yes. I think that's probably still going to be the case, but there's some things that are decoupling here as well. Traditionally speaking, when you had increased earnings, you saw increased dividends. But when you have a lot of these companies, particularly the 7 to 10 companies that are leading the S&P 500, the Mag 7, that are all tech heavy, leading by building out AI initiatives, which takes a tremendous amount of power, and there is some political rhetoric around whether they're going to pay for that or not. You know that they need the money for capital expenditures to build the infrastructure, the models, the energy plants, presumptively based on what the White House does here as it relates to that subject. So they're not paying the dividends they once were. Actually, dividends are at a near 20 or 30 year decline. So that's going to not be given back to us, the consumer. You're going to have employees be less valuable FTE wise than the efficiency you can get from AI. So where does the money go? Yeah, the companies will make more money, but they're spending a whole hell of a lot during this infrastructural period. And I think that spend is probably going to stay high for the foreseeable future as you build out AI, as you build out power plants. None of these are short-term endeavors. So as much as he says near-term, long-term, what's near-term? Is near-term a year? Is near-term 5 years? Because I see AI growing for the next 5 years. And as it grows, its need for compute. And what powers compute? Electrical power. So you're going to see that be probably your best significant set of circumstances. I love your setup on the live stream. Thanks, man. I spent a lot of time with the boys trying to get this to a place that was clear, articulate, and consistent. We'll go to the comments here for a little bit. The live stream has been a work in progress. The charts have been something that we wanted to provide that were meaningful. Let's take a look at the market status while I'm doing this. We wanted to provide an ecosystem that was clear and articulate. We've seen the Invesco QQQ, the top leaders of the NASDAQ, the top 100 come down a little bit. So we're still in a narrow tech-led rally, but if you look here, we're coming back down to what I would call a mixed day. So that Chevron will move this way or that way depending on how the market does. Yeah, mini nuclear reactors. I do think the energy sector is going to be a big growth story in the next 5 years. So I think not crude oil, but I think electrical power, the electrical grid, the system. If Elon Musk and everybody can get power outside of the planet, I think that's probably going to be a real thing. As much as that sounds kind of like sci-fi, that's a real future endeavor that's going to have a whole ton of applicability to humans if we can get that going, because the level of compute that we need is insatiable, whatever. So yeah, the setup in the live stream has been, we wanted to provide clear vision, but be very simple. So I was a little worried when we put all this together that the colors and stuff like that on the charts with the heat maps and everything else was a little bit too derivative. And I also didn't want this to, Dow Industrials are now flat on the day. Look at that. So one of the things I didn't want to do was overcomplicate things, and I didn't want to just give you data like you see on places like CNBC and a lot of the news outlets. I wanted to find a way to articulate and make the data digestible, if you will. And in doing so, this is what we came up with, and I think it serves its purpose well. We also have some other features which I haven't really shared a whole lot about, and I probably will in the future. Again, this is all static market look stuff. This is what the market looks like today. So you should feel pretty comfortable that we're in a bit of a mixed day. I am going to call this a mixed day already because we're seeing. And let's pause here too. I think one of the things you see down here is what happens most days. You'll see the day kind of settle out as you get closer towards 1 p.m. Our time on Pacific Coast time, 4 p.m. on the East Coast time. My friend's working on the first mini reactor for Oklo test in Idaho. Really? Tell me more. Send us an email at media@Higher Standard Podcast. We'll take a look. Keep up the good work. The live is good. Thanks, man. We're working on it. I know that we're not going to find new followers from this. This is more people who just anecdotally follow us, connect with us, and want to share and continue to be with us from the podcast to this, and we can have a little more thoughtful conversation and be a little more engaging. But the whole idea, back to green. The whole idea is that we can provide real-time insight throughout the day and connect. I also like the poly market bar down here, Well, Bitcoin hit 100,000 in January, right down here, and 42% probability. There's been really interesting stuff on the poly market bar. Predictive markets are a big deal. I do like them. I think these are valuable to look at, if not anything else anecdotally. I think they're kind of cool. Let's check how some of the kids are doing today. Because of all the conversation that we know that's likely to happen in Davos, I am curious to see what the market is doing for some of the housing and some of the home builders. Let's take a look at the home builders real quick. I could use a stimmy. Good comment there. Let's look at the home builders real quick. I think Toll Brothers is one I wanted to take a look at. If I can find the stock charts. There it is. All right. TOL. We'll generate a chart. And let's go to the stock. I hope this pushes because it should. There it is. All right. Great. It does. All right. Perfect. I should add some benefits we made here inside Regil if you're out there. Let's take a look at this here. And on Instagram. Love the poly market bets on the bottom. Thanks, man. I like it too. I think it's cool. I'm all for it. We'll see how it goes. So I made some corrections to this chart here and some of the chart work that we do. One of the things we've done historically, and I'll give you a comparison here. So this is effectively the way the charts used to look. Let me flash to the 1 year. Very clear chart, very communicative. We added 2 decimal places, anything below, I think it was $1,000, because I think having a tighter, narrower spread here is more indicative of what's happening in the stocks. So that was a big change there on the market charts. I also, from the 1-day view, wanted to be a little more thoughtful in how we present. So instead of comparing today to yesterday, we're looking at intraday trading here. And again, these values are there, but we also added the day's session low and the day's session high with these dotted lines here and these dotted lines here. And the reason why is so you can see how it's performing throughout the day. This one obviously is not a good one, the Toll Brothers. I think what's going on in Davos may be impacting this, but you can see the trajectory there, and it is at near session lows for the trading day, down a pretty healthy amount, $2, down 1.35% on the day. So the idea is to give everybody that perspective of chart here. Let's take a look at DR Horton. I want to say is DRH. I want to say. Probably should be really. Nope, that's wrong. Is it DH? See, I try to do this from memory, and nope, Definitive Healthcare. Look, I can't. I used to be so much better at this off the top of my head, and then it just all went south. Here, I got them right here. DHI. See, there you go. That's my problem. Let's take a look at DR Horton. We know the chart works for other companies, though. That's good. Let's see here. All right, perfect. DR Horton. Oh, down 3%, down $4.83. Look at that trend. That is ugly. So session high up here, session low, trading again near the session low, trading down in that trajectory for the single day, down $4.83, down 3% on the day. This is kind of what I expected to happen. I think the home builders are getting kicked right in the ding-ding. I wouldn't feel too bad for them, though, if you we clear the chart real quick. We look at this chart on a 1-year perspective. They're still doing pretty well in the year, last I checked, and there you go. Yeah. One last one. Let's check Lennar. We'll take the 1-year chart first. It's been a bad year for Lennar. Down 12%, 16.46. And I guarantee you the 1 day ain't a whole lot better. Yeah. Down $4, 3.44. And so here's an interesting thought, right? That's supposed to be an arrow. not a good arrow, but you get the point. Here's an interesting thought. One of the other changes we made here too is we also added, you'll see it creep up on the day there. So just like CNBC and some of the major platforms, it'll actually pull forward as we get through the day. This is today's trading only. So not to be confused. Some people say 1 day, they meant comparable to the day before. So look, you could argue that if the president comes out and says something that is not adverse to the home builders during Davos's conversation next week, this could go up. This could be a quick play to grab some quick cash if you're into that kind of thing. Me, I'm a long-term holder kind of guy. I don't do that. I do think these are value plays. I don't think the home builders are going anywhere. If you look at some of the things we've talked about from a previous part of this conversation, like affordability, like that, we got a good healthy amount of supply, but the ability to buy has been strained by the mortgage payment burden, mortgage rate pressure, and obviously home prices and wages, which I've got to find a chart for wages that comes into this. So because of that, I don't think the home builders are going anywhere. Yeah, sure, there's an excess of supply here, but once this solves, that supply will get purchased up pretty quickly, right? So let's walk this through logically. Let's walk this through just from a fundamental perspective. Let's go back to the stock chart for a second while I'm doing this. If you're saying that the president's going to come out and say something in Davos, institutions can't buy, which may affect some of the home builders who build to own and build to rent. Okay, fine. They can tap into their home equity line of credit, 50-year mortgages, maybe, all the things we've heard, right? Well, I mean, if those things are happening, then, well, that's going to boost sales because it's going to increase the ability to buy. And that supply at 89 will come down as people buy and deliveries continue at their same pace, right? They're not going to increase, astronomically in the next couple of, months and weeks and years. So home builders are going to benefit ultimately from whatever is announced in Davos. So I do think that if you're looking at this chart and you're saying to yourself, okay, well, hey, these guys are sinking, I think over time that's going to prop back up. We saw a very similar trend in Chevron and in the crude oil companies when we heard about Venezuela. Well, now look at it, right? Chevron's creep. Actually, let's check Chevron out real quick. What is it, Chevron? CVX? CVX? I should probably know that. Yep, it is CVX. Let's take a look at their chart, stock chart there. So look, yeah, they're down incrementally on the day, but let's go over the past, 1 month, I think. Take a look. There you go, 1 month. That's Chevron, right? And the reason why is they're the only person there. Everybody else, the suppliers, the shippers, they're not doing too well. It's the refiners that are going to pick up, and Chevron got the near-term bump because they were first there. This is very similar in the housing space. I don't think you're going to wind up in a set of circumstances where I think they're going to they're brought down by the narrative. This is the behavioral economics that gets built into things, but I don't think that the home builders are going to take it on the chin here. I think they're just waiting their time and buying it because this is going to really turn into a meaningful thing for them. So my 2 cents. Let's go to the comments. Check out PE right now, below 200-day trade. Oh, let's take a look. I like stock commentary mid-show. Bring that on. That's what we're about here. PE. I'll take a look at 1 month here. Let's go to the stock chart. Huh, it's not generating. That's weird. Sorry, brother. It ain't pulling up. Maybe it just doesn't like you. We'll do that next time. Don't worry about it. Let's see. Let's check the comments here as well on other platforms. I've been a little bit off of their feeds here. What does one do if they pay mortgage level rent, but the only thing holding them back is not being able to come up with a down payment? Well, my friend, you may be getting, Meta platforms. Yeah. PE ratio. Oh, I was like, wait a minute. Sorry, my bad. I probably should read better. Yeah. Meta's an interesting one. I think Meta's falling. Well, okay, I'm going to answer Regil's question first, and then I'll get back to the Meta PE thing because I got some thoughts on that too. So, Regil, if you're somebody who's paying mortgage level rent right now, okay, and let's get serious for a minute. Let's just look you and me right in the eye holes of my sockets, okay? If you are somebody who's paying mortgage level rent now, but you don't have the down payment, which is a very common problem in some of the major MSAs that have a higher cost of living. If Trump does announce this 401k ability to tap into it, and you do have a 401k that's got some wherewithal, that's part of the solution. So let's be depictive. There you go, 401k. If Trump comes out and says 50-year mortgages, I hate them. I do not like them. I think they're very bad. But that could be part of the affordability nexus because you're going to stretch your payments out longer. Now, I would say get some equity over time, refinance into a 30-year mortgage, that whole concept. But again, whatever. We know that Fannie and Freddie are buying $200+ billion of mortgage backs. That's going to bring interest rates down about 25 to 35 basis points. I think you've already seen it. You saw mortgage. God, my writing sucks. I apologize. So you've got a Molotov cocktail of things that are going to happen here. And because of that, I think what you're going to see is you're going to see affordability improve from a rate and payment perspective near term. But this will drive up home prices again and cause this problem to continue to rear its head because the only other two solutions that we have available to us are unlikely. Home values coming down and people making more money. And I don't have a solution for that. I think long term, that's something that needs to happen, and what that looks like and how that plays out, I'm unclear on. But yeah, I think there's going to be an opportunity to buy, and I think there's some strategic things. And Regil, you work with me, so we'll have a conversation about that, and I'll I'll find a way to help you guys find that situation and make it work. Now, let's get to Meta's PE ratio, baby. So Meta has been taking it on the chin. Do I need to say it? Virtual reality was not quite ready for the big time. Now, I like the Meta glasses. I like some of the stuff that they're doing. But I will say that they have taken it pretty badly for some of the expenses in recent years. And you're talking billions of dollars of money that have gone by the wayside. So their price to earnings ratio, to me, does not seem to be, frankly, concerning. I think it's a near-term problem. I think you got a chart which shows long-term confidence in them. This is the day, but this is gonna trip you out. This is 1 year. You ready? And there you go. Yeah, relatively flat. So other than a dip we saw here, I don't know if you guys like this or hate this, but April, May, June, July, August, September, October. So we just skip a month and show just a single, first month. I'm trying to make this simple. But in any event, yeah, other than this dip, I don't see a whole lot of concerns in their stock long term. I think their earnings are going to get back to where they are. People are addicted to social media, man. And I will say their augmented reality game, I have the Meta display glasses. I'm a big fan. I think it's real. I think they can probably take some of that lost CapEx that they dumped into virtual reality and dump into augmented reality. So I think the PE price to earnings will improve over time. And I don't think that earnings for any of these companies are going to be meaningfully impacted other than their tripling down into compute and the capital X expenditure into that, because that is a real financial problem. So I think dividends will be limited, which really sucks if you're Mark Zuckerberg and you're making hundreds of millions of dollars in dividends every single year. Duke of the Dondo, solid name. Appreciate the fire emoji. Anybody else? Questions, thoughts, concerns? I did want to cut this one short at about an hour. We got a holiday weekend coming up. We're going to all celebrate, take a day off, and enjoy it. So a question for people. Thanks, man. Eyes locked in. I appreciate you, Regil. And I'm sorry I can't get the quotes up here. That's it for today. I do have a bunch of other stuff that I want to roll out in the coming weeks. We're going to do similar chart work for, again, look back in current market affairs, and then we'll do some future prediction stuff later on. But that's going to be jobs and employment numbers we're going to find out there. We're going to do a macro data, and we're going to do this a little differently than most people. We're going to look at the calendar of upcoming release events, and we're going to show you the predicted number and then the ultimate the number when it comes out. So we'll be able to look at that and see how close or far we were from predictions. I'm actually thinking about putting in Saeed in my own individual predictions along with the market's predictions. But so we'll have a good idea of what inflation, prints or like PPI, CPI prints are going to be before they actually come out. We're going to tell you what we think they're going to be, and we're going to use that to future forecast a up or down scenario with some of the analytics. The whole concept that we're doing here with the lives, as much as I appreciate you guys tuning in, is to really have a date down for how we build the model and roll certain parts of this out. Because as the model gets more and more complex, and we're pulling in data from a ton of sites right now, we're going to start this future predictions piece of this using AI, using APIs from the St. Louis Fed, using API pull-in from a couple different sources, including where we're getting the stock market trend data and everything else. We're going to look at some currency stuff. We're going to look at cryptocurrency, most definitely. I got to find a way to pull that into the show in a meaningful way. I really, really want to do that. I'm just trying to find a good way to do it that's cost effective, I guess. And then we're going to have some really cool stuff. So bear with us over the next couple of weeks while we continue to roll out. This is what the market says today, because that is the foundation of what we're going to do our prediction stuff based off of. Thanks for tuning in, everybody. I sincerely appreciate you. I'm going to hit the end button here, but this is doing something wonky. So if you get a bit of a pause afterward, it's not me. It's just the software doing what the software does. See you on, there will not be a show on Monday. We're taking Monday off. It's a holiday. There will be, the next live stream we'll do will be on Wednesday. All right, everybody. Take care.